Good afternoon, everyone. My name is Jeff Kikel, and I want to welcome you to our webinar today. This is the first of a series of webinars that we'll continue to do each month on the last Wednesday of each month, called our Savvy Business Owner Series. And what the Savvy Business Owner Series was created to do was just to give those of you who are business owners out there the understanding of some things that you may or may not know. And one of the challenges that we face as business owners is we don't know what we don't know. And if the people that we work with aren't bringing those information or that information to us, it becomes very difficult for us to run our businesses. And, once again, you don't know what you don't know. And sometimes that can hurt you. And sometimes it could have helped you if you knew about it. So today we're going to talk about a presentation that I do called What They Didn't Teach Us in Business School. And we're going to really focus on three major topics today. First off is executive benefits. The second is key person insurance and buy-sell agreements. In my experience working with business owners, I can tell you this is one of the areas that people really don't focus on, especially small business owners, on the key person insurance side and the buy-sell agreement side. People just don't look at those areas. And one of the challenges that you face is if you don't look at those, it can come back to bite you immensely. We'll have a couple of videos that I'll share at the end that are real life stories of people who, fortunately put some of this in place, and you can see, the effects of that for their businesses. And you can imagine what would have happened had they not done this. We will cover an extensive amount on executive benefits today. This is an area that I have a lot of expertise in, and our firm has a lot of expertise in, and I want to really share these with you because these are some wonderful tools that you can use to retain, reward, and recruit key employees to your company. So let's get started. I want to give you a little bit of an overview. So today what we're going to do is we're going to cover understanding of executive benefits, understanding what's out there, what type of compensation methods you can use, understanding non-qualified compensation alternatives, the things that are out there, understanding key person insurance and why it is critical to your business, and then understanding buy-sell agreements. And this is extremely important, especially if you have any kind of partners in your business. So before we get started, I wanted to share a little bit about myself. My name is Jeff Kikel. I am the president of BKA Wealth Consulting. BKA Wealth Consulting has three major areas or three businesses that we have. So the wealth consulting portion of our business, we are a registered investment advisor. We have over $100 million in assets. We're registered with the Securities and Exchange Commission. And what we do differently is we typically work mostly with business owners in our business. We have structured the business around that. My business partner and I started the business with that in mind. It was who we loved working with, not to say we don't work with folks that may have worked for somebody else and then have retired, or people that are working for someone else, but our major focus is on business owners. We developed the business to be able to do three things. One was help business owners with their wealth management, which business owners aren't always the best wealth management clients because most of their businesses, most of their money's tied up in their business. So we had to create some other ways that we could work with business owners. Those other ways are our business consulting arm, BKA Business Consulting, which focuses on two major things. One is business valuation and appraisal. And the second piece of that is about our exit strategy planning. So really helping business owners figure out what that exit is. And the last piece of our business is BKA Benefits. And we are a full service benefits consulting firm, everything from healthcare to voluntary, supplementary benefits to retirement plans. We do all of that along with non-qualified retirement plans. So we both do qualified and non-qualified. We'll talk about what that means here in a minute. So we're going to get started talking about key employee benefits and specifically retirement benefits when it comes to key employees. One of the challenges that key employees and owners face in a business is that they quite often want to save, have the capability to save because they make more money than other folks that work with the company. But the way that the qualified plan system works and the way IRAs work, they're discriminated against because the way a 401k works is everybody has to have an equal ability to contribute. And if people in your plan are not contributing enough, they're not contributing enough of a percentage of their income, it limits the percentage of income that the owners and the key employees are putting into it. And key employees are basically defined as anybody making over about $118,000 a year or that have more than a 5% ownership stake in the company. So what is the challenge? Well, we have what's called a retirement income gap because, you know, if I make less income, so if I'm on the left side of the chart on the screen, then I can replace more of my, or I can replace up to 100% of my income currently by just properly saving. And I have, you know, multiple vehicles. If I have a 401k plan, I've got the ability to save up to $19,500 and I get an additional $6,500 if I'm over 50. So that gives me the ability to put a lot of money away in relation to the amount of my income. However, as I start to get farther and farther up in the income scheme, then that $19,500 becomes less and less of a percentage of my total income. So that means I have a harder time putting money away because I'm just limited by it. And Social Security benefits, as I have a higher normal income, you know, Social Security benefits are capped. So they're only going to get to a certain point as we're going. So this is why we have this big gap. And a lot of, you know, employees are looking for ways to save additional money, especially your key employees and your owners of companies. So why implement executive compensation? Well, yeah, most times the executives that you're recruiting into your company, that you're trying to keep in your company, they are people that you really can't afford to lose. These may be people that have years of industry experience. They have years of experience within your own company, and they are attractive targets for people to take away from you. So what you want to do is avoid losing them if you possibly can. So when you start to think about the different vehicles that you have available to you, well, you know, you can use these vehicles to retain, reward, and recruit, meaning you can take people away from somebody else. In the world of the Fortune 500, these type of things that we're going to be talking about are normal and they're commonplace. And it's a reason why people and executives will migrate towards these larger companies because they'll receive all kinds of extra added benefits more than a salary or a bonus structure. When we start to think about this and we start to look at these different plans, there's multiple different ones that you can do. So these are the traditional and typical approaches to executive compensation. First off is equity compensation. And I hear this a lot, especially in the tech industry. We do a lot of work in the tech industry. And, you know, the most common thing is, well, I'll just give shares of the company. I'll give ownership in the company, which if you're a multi-billion-dollar company, yeah, you can do that. Because when you give out shares, you know, even if it's a couple $100,000 a year in shares, that's such a small component of the total value of the company. It just doesn't have a whole lot of effect. And those individuals who have ownership have no say basically in the company at that point. When you have a smaller company, and this is where the challenge comes, especially with startups and newer companies, people want to, well, you know, I can't really pay people well, so I'm going to give them shares of stock. And the problem is you end up giving away a somewhat significant chunk of that business that now, if you decide to sell or merge, you've got to get approval from all those individuals that you worked with. Or that you've given equity ownership in. So the challenge is you don't necessarily want to have to get approval of your employees if you can avoid that. So other companies will say, well, I'm not going to do that. I'm just going to do what's called phantom stock. And we'll talk about that in a minute. But phantom stock is really not stock. It's actually effectively just kind of a back of your mind, or maybe even written down transaction that you would share with your employees later if you sold the company. And then, of course, bonuses are a very common way for executive compensation and really compensation of employees. So let's talk a little bit about executive compensation. First off, the pros to it. First and foremost, you get engagement and buy-in in some cases. I will tell you, if the company is successful and they're seeing things like dividends coming to them, or if the company is rising in value, they're engaged. If the company is losing money and is going down in value, their engagement slowly wanes away because they're not really seeing that advantage. There is a vesting schedule, so it's a way to lock people down so that they don't leave your company and they don't get recruited away to somebody else. Some of the cons to this is, we talked about it just a little earlier, equity dilution. The more and more people you add that are shareholders, that means the existing shareholders get diluted, meaning that they have less and less of an ownership stake in the company. Most times, and you'll see this quite often, especially in early stage companies where people have gotten a lot of equity shares when the company was still not public and was still struggling, and then the company goes public, well, a lot of the employees cash out right away. They just get out of it immediately because they don't want to take the risk that the company goes downhill, or they just need the money. So that whole, engagement and buy-in really starts to go downhill as they start to sell out of this. They're just looking at it as an opportunity. And I'll give you an example. I worked with a company where a chief employee of the company, he got a very nice equity grant and looked at it and said, you know what, that's probably the most money I'll see in my life. I'm just going to go ahead and quit. I'm tired of working 17-hour days. I'm just going to go ahead and quit and go do something else and have more than enough money to do it. So that's an instance where that equity compensation was actually, this is a critical key employee who is leaving the company as a result of that. Phantom stock. This is where phantom stock, you're seeing people give shares in their own mind to an employee. So let's say I'm the owner of a company. I have some key employees, some key people that I've really wanted to keep around, maybe some executives. I can say to them, well, when I sell the company, and there will be a point in the future when I sell the company, when I do, I'm crediting you with having, let's say, 10,000 shares of our stock at that time. And what I will do is, when I sell the company, that's money that is going to come to you being a loyal employee. So one of the advantages to that is it's a cashless income alternative. So I don't have to really do anything up front. It's more of just a book entry thing. There's no share dilution at all because I'm not really giving them anything. I'm not giving them actual equity. There is one little thing from a bookkeeping perspective. It does create a charge on your income statement, a charge against your income statement. So it is something that does have an effect on the actual books of the company. And there's really no true ownership. A lot of employees that get phantom stock are looking at it as like, well, I mean, I don't know how long I'm going to be here, and I don't know if I'm going to be here long enough to really get to take advantage of this happening. Then bonuses. Now, if you ask most employees, they will say, yeah, I'd love to have a bonus. That's my favorite thing. I'd love to have a bonus because they want that cash in hand. So it's immediate income for the employee. It's an immediate tax deduction for the company, which is a good thing in some cases. There is no vesting, unfortunately. So you give them the money and they have it, and they could easily leave. I always laugh. One of the companies that I worked for 17 years, it was hilarious because you had to be employed on the first day of the year, or typically the second day of the year, because first day was, New Year's. So you had to be employed on the second day of the year to be able to get all of your annual bonus from the previous year, your matching in your 401k and everything else, and then everybody would quit. So you would always wait for, the second day of the year, and then you'd find out how many of your friends quit from the company, because there was really no vesting at that case. There's really no true ownership of the company for the employee. I mean, they just get money, which they want, but they don't really have anything that's holding them there. So there's other alternatives to you, and this is really where we get into what are called non-qualified, either deferred compensation plans, other type of plans that we'll talk about. So first off, when we start to think about ways that we can contribute to our employees, the first thing that comes to mind is 401k plans, right? You offer a 401k plan or some other type of retirement plan. You use this as a recruiting tool. Hey, we match. There's tax benefits to the company by matching or giving profit sharing. We get a tax deduction immediately. It's very flexible. People understand it. They like the fact that they have an ability to put money away and either put it away in a traditional 401k where they get to reduce their income, or into a Roth 401k where they pay tax now, but then they never pay tax on that in the future. So that's the first way that people get compensated. But the challenge is when you talk about 401k plans, I talked about this earlier, 401k plans, if you don't match enough, or let's say, and I'll give you a really good example. This last year, we had COVID. People were shutting down businesses. One of the first things that a lot of business owners did was they said, you know what, we're stopping our employee match. We're just not going to match. Well, what happens is when you stop matching, a lot of those lower paid employees are going to go, well, if you're not going to match, I'm not going to put money into the plan. So they stop making contributions, or they're concerned about the economy too. And so they stop making contributions. What ends up happening then is the people in the company who could save are now limited. Those highly compensated folks and the owners of the companies now are limited to the amount of money that they can put in. And that limitation is what's called an Adp test. So it's an average deferral percentage. So let's say you have a group of employees, there's 100 employees, 50 of them don't contribute to the plan at all. 50 of them only put in about 3%. Okay, so you take all 100, you average it out, and so that's 1.5% average deferral percentage that the employees are going to put in. The way the rules work is the senior employees, the highly compensated employees, the owners of the company can only put in 2% more than what the average deferral percentage is for the rest of the employees. So let's do the math. 1.5% was the average deferral percentage, plus 2, the average, what I can put in as a highly compensated person or an owner of a company is only 3.5%. Now, if I make $500,000 a year, I may be able to get somewhat closer to that $19,500 number. But the reality is I'm probably not going to be able to, and so I'm only going to be able to put in a couple $1,000s a year. So what ends up happening? Well, here's what ends up happening. The highly compensated employees go ahead and keep putting money in while everybody else stops putting in money during the year. And this happened last year. At the end of the year, there's a test that is done to do what they call plan testing. And what ends up happening is they do plan testing. They look across what everybody compensated or put into the plan. They figure out what the average deferral percentage is. And anybody that contributed more than they should by the end of the year, sometime in the beginning, usually January or February after the testing's done, the 401k provider is going to come back to the company and say, well, hey, Bob, Judy, and Mike contributed too much, so you need to refund those contributions. What happens is now all of a sudden they get a check back for $17,000 that now is taxable income in this tax year that they weren't planning on. And now all of a sudden they have to make, and that gets backed out of any deduction that they got from the previous year. So now they're not happy because they have a tax burden that they weren't really planning on. And you've got those people, boom, into the office of the owner. And when this happens, the owners just get beaten down, and they'll, these are the people we'll talk to that will say, I hate 401ks. They're too much work. Everybody hates them. All my senior employees hate them. I hate them because I can't put money into them. With a little bit of plan design and a little bit of forethought, that could have been avoided. But if you work for a company or you own a company where it just doesn't make sense to have a matched 401k plan. I will give you a great example of this. We do a lot of work with construction firms. Construction firms have usually about a third of their employees will turn over every year. There are people that go from job to job to job. Sometimes they might not have work for them, so they just kind of lay them off. So there's this constant flow. Then they have about a third of the people who are there for multiple years, but they're just people who don't really have a good financial education. They tend not to save. So they're just people that are kind of out there. And then there's that other group of folks that are kind of key employees. Maybe that's your folks that are a supervisor or a foreman that have been around for a few years. And those are the people you really want to take care of, but you can't really do much for them because everybody else doesn't want to contribute to the plan. So you can set up what's called a non-qualified deferred compensation plan, or what we call a 401k mirror. So effectively what it is you have your regular 401k plan where everybody participates, and then you pull this group of folks out of the company that now are part of this non-qualified 401k mirror plan. And you have the ability to effectively write the rules there. They have the ability to contribute more than they would have been able to in the 401k. There's no average deferral percentage, no testing. You can even match to them. So you can have a different match for that group of people. In the case of the 401k and a qualified plan, you cannot discriminate against any employee. That means everybody has to have an equal ability. Everybody has to have the equivalent service. You have to provide them the exact same thing to every single employee. In the case of a non-qualified plan, it's the exact opposite. You have to discriminate and only have a certain number of people that are part of this plan. And they're typically key employees, highly compensated, owners of the company. It's a pretty simplified plan. Now, there's some wonderful benefits to it. There are a few drawbacks, and that is that this money is at risk. If the company were to go bankrupt, that money could be at risk, unlike a 401k, which is its own separate trust. And that's what makes it a non-qualified plan, and it allows you to defer that income. So you have the ability to defer that income for whatever period of time you're allowed. Some of these will have a minimum period of time that you have to put the money in there and keep it in there. Others, you might be able to select, well, I want this money in 5 years or 10 years or whatever. There is another type of a plan called a Serp. So this is a supplemental executive retirement plan. And what this does is, if you think about the way pensions work, this is money that, you work for a company for a period of time, and then I have the promise of getting paid a certain dollar amount later on along the road. So the basic anatomy of a Serp is someone, the company contributes money into a financial institution. There is an agreement between the employee, the executive or whoever, and the company that says, well, if you work for this number of years, we will contribute X dollars over a period of time to you. And at the end, you will have access to this money after, let's say, 5 or 10 years. You get to set the rules. There is no given strategy. There's no specific thing that has to be done. There's no minimums. You have to be reasonable when it comes to this. You have to be able to say, hey, I don't want to have more than, let's say, a 10-year period of time where, we've got a restriction on it. You want to be able to give them little bits of this over time. The reason for that is you want to encourage them. You don't want to make them feel like, well, I've got to be here for 10 years. And then at 10 years, I'm done. I'm out of here with this money. But in the end, the company initially doesn't receive a tax deduction because effectively it's moving money from one pocket to the other, still inside the company. And the employee does not have ownership with this yet. And that's what's called constructive receipt. And that's what allows this money to be set aside for the employee. It's not a taxable gain to them today, but when they have access to it, once that surrender is over, at that point in time, when they start to receive payments, either in full or in monthly payments, or annual payments over a period of years, as they receive access to it or constructive receipt, they're going to pay taxes on that money at that time. There is a structure that we have created, and this is something unique to BKA Wealth, that we created called a Keysop Plan. And what this came about, this was actually from an employer that we worked with. We had done a business valuation for the owner. She had built a very successful business over 10 years. And she's up in her early 60s, and she's kind of looking at that next step. And one of the conversations I had was, well, I mean, what's the next step for you? What's your exit strategy look like? And she said, I think 7-10 years out there, I'm kind of done, and I really want to be out of this business. So my next question was, well, do you want to sell it to somebody else, or do you have somebody in mind that's going to take the company over? Well, she had hired somebody that was a key employee that she wanted to have come on board. She brought her on board with the intention that later on down the road, the company would transition to her. So, one thing could happen, which was, well, the owner of the company could have kind of funded that transition, funded the sale of the company. The challenge that you face with that is you're turning your company over to somebody else, they're running it, and there is the risk that they don't run it as well. You're financing this, which means to protect your investment, you've got to come back into the company when you're in your 70s, and when you probably don't want to have to get pulled back into the company. You want to go enjoy life. So we created this strategy called a Keysop. And basically what that means is key employee structured ownership plan. And basically what that is we use the concept of a Serp that we were talking about on the previous screen, where the company is funding a plan for the employee, not necessarily for retirement, but the company is using part of her compensation to fund a plan that's going to give her assets at the end of this to be used as collateral to be able to get a loan to buy the company at that point from a bank. And then what we also looked at was the owner of the company is cash flowing like crazy. And, it was building up cash inside. Her CPA was saying, hey, you got to do something with that. You got to get it out of the company. She was already putting money into, 401ks and everything else. So we created what was called a Section 162 plan for her. As an owner of a company, there's not a whole lot of tax advantage things you can do when you are an owner and you are and in this case is an S Corp. So any of those pass-through entities, you really can't do much in the non-qualified space to be able to get an upfront tax deduction. So what we looked at doing was, all right, let's carve some of this money out. It turned out to be about $350,000 a year for 10 years. And what we're doing is we're building that money up for her. That is going to be supplement for her retirement. This is a case where we used an insurance policy for that vehicle. The reason for that is that money grows inside of that policy. It's structured not for the insurance piece, but for the cash value growth. And that money is growing for her. It's going to allow her that in year 7 is what our plan is. The transition plan is going to start to go into effect, meaning that key employee is basically going to be groomed up to that 7-year period. And then at year 7, she's really going to take over running the company for the next 3 years, while the owner sits by as more of a coach and a mentor for her and is there to kind of help in that transition. At the end of that 10-year period, that Keysop plan is going to give access to the employee. She'll have access to that money. It'll be about $600,000 at that time period. She'll be able to go to a bank and get a loan for that piece of it. We know she'll be able to afford that loan easily because of what the business is cash flowing currently. That loan will pay back, and that the owner stands by, when we built this, the owner will stand by and loan money back to the company if they need a little bit more money for collateral. The bank loan is done, that gets paid back to the company, which then pays back the loan to the owner, and the other assets come to the owner. At that point, the key employee is fully in charge, owns the company 100%, and the owner, the previous owner, now she's off on her own doing her thing. And I told her, it doesn't mean you can't come back into the company, but you're going to be hired back as a consultant, a paid consultant at that point, instead of being forced back into the company. We also created a unique plan at BKA called the Executive Retention and Retirement Plan. And this is really more for companies that probably are going to sell down the road. It's not going to be a company that's going to go public. These are not going to be companies that are going to go public through an IPO or a SPAC. They're private companies. They're most likely going to be acquired by a larger competitor or someone like that, or somebody that is in a related industry that's doing a strategic buy. So in this case, and this was a client of ours that we created this for, what we looked at was the owner of the company, along with 3 of his key executives, actually technically 4 of his key executives. He wanted to start to kind of reach towards the future and lock down some of the buyout cost of that. Very successful business, cash flowing well. And you'll see this when it comes to these type of plans. One of the key things is you got to be a stable business. You can't be losing money a couple years in a row and then making money and all that. You really need to be a stable business to do these type of plans. But what happens in this case is the company goes to a bank or a finance company and says, hey, we're trying to buy a little bit of our future value today so that we can kind of lock some of that down, because we don't know what the future is for the economy when we're looking to sell this. So we want to just lock down some of that, what's called goodwill, right now. So they go to the bank. Bank says, all right, well, let's look at your financials. Yep, you're solid, you're good. All right, we're willing to loan money to you. And typically this is done over either a 4 or 7 year time period. Most of the time it's going to be 7 years in these cases. That money then is loaned to the company. The company pays a taxable bonus to the employees. So what that means is they actually pay the employee, and then they pay them for the taxes that they're going to pay. That employee then receives those dollars. That money is then invested in an insurance policy. Now, normally you'd be able to just say, well, that's my money, I can do whatever I want with it. But in order for the company to lock down that key executive, they need to have an agreement with that executive. And that agreement is what's called a REBA. It's a restricted employee benefit arrangement. And that REBA, what it does is it says, all right, if you leave the company or you break some rule, you leave and then try and take clients or something, you've lost that money that you put in there. And we have the ability to claw that back from you. We have a legal document. From the bank's perspective, as the cash value inside of that insurance policy, and once again, this is not bought for the insurance purposes. We want to buy minimum insurance. We want to have maximum cash value growth. The benefit to that is, as I take money out down the road, that money is tax-free to me. So as an employee, as an executive, this is a wonderful ability to almost have like a hypercharged Roth IRA. And because the company is leveraging this, they're able to put in a lot of money very, very, very quick, because they're putting leverage on their balance sheet, which they're going to just pay back over time. And typically that's maybe over that 7 to 10 year period of time that they'll pay that back as a company. The banks love this because, yes, they are loaning money to the company is taking that, putting it into this plan. But one of the nice things for the bank is that cash value that is sitting in those individual policies for, like in this case, the 5 people that we did, that money is collateral back to the bank. So if something happens, the company defaults, that money that was put away into those individual policies, the bank can go in and grab that money back, or can sue and get that money back. And then that's collateralized for them. So they love this type of stuff. Employees and executives love this because this is an additional added benefit that's being added on to them. This is something that doesn't require you to give equity to these key employees. You're just putting money away for them. That life insurance policy is typically written with 3 clauses on it. First off, it's tax-free income to the executive whenever they get to retirement. Let's say they're 65. Now they can start taking tax-free withdrawals and loans from that policy for the rest of their life. We typically will write these with disability and long-term care built into the policy. So if something were to happen to them where they get disabled, they have a stroke, they get into a car accident or something, they get into an accident at work, this is additional disability that gets tacked on to any other disability policy that they have. And let's say they have a stroke and they need care, well, they have long-term care that can be pulled out of these policies. And last but not least, the one that you don't want to have happen, but it could, something happens to that person and they die, that death benefit that is part of that policy gets paid to their heirs, to their family, and that's a tax-free death benefit. So it's one of these vehicles that really is something that we had to really put this together and make it work for a client. And it's something that we've now taken forward for a lot of other clients. So pros and cons of non-qual plans. From a pro perspective, there's no top-heavy testing, the ability to discriminate. Once again, you have to. Almost unlimited funding of these. You can put a lot of money into them. It can be less costly to maintain. In fact, most of the time it is way less costly. It's a little bit of legal work at the front, and then really there's no ongoing cost to them. And they can solve multiple goals: retirement, disability, and death. The cons: one, the funds are at risk of forfeiture to creditors. You're right in there with all the other creditors, and they may have a higher level than you do as far as getting money out of a bankruptcy or something. It is a contractual obligation and not a fiduciary agreement. So fiduciary law says that I am legally bound and can be sued beyond belief. A contractual obligation, same thing, but you have to trust that both parties are going to follow the law in those cases. Vesting schedules can be longer, and that can lead to employee forfeitures or them just kind of not really being overly excited about this if you make it too bad. And this is not a con for the employer. It is for the employee, the ability to claw back dollars that have been given to you through that REBA. Now, we're going to switch topics. We've still got a good amount of time left for this time period. We are going to switch topics and talk about key person insurance. So, we've talked about ways to maintain these employees, keep them on board and everything else. When we start talking about key person insurance, this is more about the survivability of a company. So let's say I've got an owner of a company that, is key. They're a big chunk of why the company is successful. They are somebody that if we lose them, there's going to be a lot of challenges to finding somebody and getting somebody else in there, or we're going to have to pay somebody to probably a lot more money than the owner is getting paid to come in to run the company. So what happens? Well, the business, which has an insurable interest, because this is, let's say, the CEO of the company, the business pays premiums to an insurer. So they say, all right, we're going to set up a key person insurance policy. A lot of times this is done with term insurance for key person insurance. Sometimes it's done with cash value insurance, and it might be a combination of either key person insurance or extra savings, on a side for the key employee as well. Maybe supplementary retirement. The owner of the policy is the business. So this is not they're the owner and the beneficiary are the business themselves. This does not go to the employers or that employee's beneficiaries. It could be structured that way to where there maybe is a portion of this that gets paid out, but in most cases, it's, the business is buying it, the business is the owner, the business is the beneficiary of this. If something happens and that key person dies, then that money is paid back tax-free to the company, and then the company can use that however they see fit, to be used to maybe hire a recruiter to go out and find this key person. It may be used to pay some kind of a benefit or a signing bonus to that key person coming in. It may be used to fund some kind of a key employee plan or a Serp to get that person to come on board and kind of lock them down for a few years. So it can be used for a lot of purposes. What I'm going to do now is I'm going to share a story, and this is a key person story that I always say you can never be too busy. And this is an example of someone who was busy most of the time and luckily had an insurance person that he worked with that cared enough about him to actually to stay on him about this. So give me just a second here, and I'm going to bring this up. Okay. All right. So let me share my screen. Okay.
In a marriage, you rely on your spouse, that they're there. You work on this team. I wake up every morning now and it's me. It's just me.
My dad was always really energetic, not one to sit inside all day.
Any motorcycle event you go to, somebody always knew him. He was just very outgoing. He was very good at what he did. He had a passion for riding.
Shane's love for motorcycles was very endearing. Not many people can pick up a bike and ride like he did.
Shane has built a business that has been growing and been sustainable for years. He did have a current policy at that time. The need that we found was substantially higher than that. We were talking about starting some life insurance on him and maybe some of his family members and some key employees. But he's always multitasking. You can never really get him to sit down or focus on anything for more than probably 10 to 20 seconds at a time. So he had convinced me to clear my schedule and to go up to the Northwest Nitro Nationals hill climbing event. Shane had a bike that he wanted to sell. We discussed everything on the way up, and then Friday night he assigned his amended application. On Saturday morning, Shane started up his motorcycle. I heard the machine take off and accelerate, and then he hit a bump and went over the handlebars.
Chris called me and I said, "Hi, Chris, how you doing?" And he goes, "Kim," he goes, "it's not good news." And he goes, Shane's gone. There was a bad accident."
The image that's burned into my mind from the look of my mother's face and my sister's face, that is one of the most traumatic things that I'll have to live with.
In any family, I think that there's always that moment that your world could change and your life could change.
The life insurance that Chris was able to have Shane sign changed our world immensely.
One of the big concerns was that the business didn't shut its doors. There were people that he hired who were also like family to him, and he wanted to make sure that could still stay open.
The life insurance money that we had enabled us to get it out of debt, to move forward in a very difficult time, and it allowed me to be a better mother, someone who could really focus on her children and to really allow a breather. I can't imagine not having something like that and going through what I've had to go through. And Shane is so proud right now.
So that is, I mean, it's an incredibly sad story, but, I think it's extremely important to understand why this is such a key, piece. It's such a key of being a business owner, and if you're serious about taking care of your family, you're taking care of your key employees, you can't afford to lose one of those key employees. This is, one of the reasons why we have to have key person insurance. I mean, it's critical. And, I mean, this is an example of a guy who was always too busy, just too busy. And I mean, we're all that way. Those of us that own businesses, are that way. We're too busy. We got too many things going on, but these are the type of things where you just have to stop, sit down, do some planning. This should be part of your annual planning with your team, your financial team that you work with, of really saying, all right, well, where are we at? What's the what if? And this is the thing when I talk about, and I do financial planning with clients and business owners, I'll sit back and I will say, all right, that's fine. We built out this great plan. We figured out this wonderful exit. What happens if you get run over by a bus tomorrow? And just stop and make people think about that. Well, okay, well, yeah, we're not quite there with the business yet. We've still got some debt we've got to get rid of. I don't know who would replace me in this role. Yeah, all right, let's think about that. And let's make sure we give you the ability, or give your family the ability, and the employees that are still there, the ability to, figure out how to keep on keeping on, and being able to provide a big chunk of money that's tax-free to the business at that time is huge. So the last topic we're going to talk about today is actually buy-sell agreements. And what is a buy-sell agreement? Well, a buy-sell agreement is put in place to basically be able to do two things. I always say there's two reasons for a buy-sell agreement. First off is, in the case of one of the partners dying, what ends up happening is, and just think of it, if this, Kim in the previous example, if there had been, let's say, a business partner in the business, well, now Kim is the other business owner. She may or may not have the experience and the expertise to help run the business at that point. So the ideal situation is, whoever the business partner is, hey, I want to be able to buy out, your shares of the business. I'm going to continue to run it. That other person, the spouse that remains, gets to be exiting from the business, but has actual funds. It doesn't hurt the business, because the business doesn't have to go into more debt to basically buy out the other owner or the owner's heirs. So in the simplest form, let's say we have owner A, we have owner B. They come together and they have a buy-sell agreement. This is actually in my business, my financial practice, this is the agreement that my business partner and I have. We basically are 50-50 owners of the business. We're both, boom, right across the board. This was something we put into place literally within a month of us getting the business up and running. And we weren't really making any money at that time, but we put this in place and funded it so that, if anything were to happen to either of us in that interim time, it allowed us to be able to sell off, or to buy back the other person's share of the business. What then happens is each owner pays the other's insurance premium. So effectively, we each are paying each other's business or each other's insurance premiums at that point. So I'm buying, I bought a policy on my business partner. He bought a policy on me. We're each of us is the owners of the other policy. So in this example, if owner A dies, so now the ownership passes to the executor, whoever that is. So it might be an attorney, it might be, an employer, or, the family member. So now I'm the family member. I'm sitting there and saying, well, I don't really want to run the business. I mean, my wife has no interest in the business that I run, so she wouldn't want to be involved in this. So what ends up happening is that owner B receives money in the insurance death benefit, gives that to me, or gives that to my spouse in that case, executor, owner A's executor. And then owner A's executor gives the shares of the company to owner B, who becomes full owner of the company. So this is a simple situation, 50-50 partners in that. If you have another partner, then it just kind of doubles the amount of insurance policy. So in this case, there's 2 insurance policies. If there's 3 owners, each of them has to buy basically a insurance policy on the other 2 owners. So that becomes 6 insurance policies. And it just kind of keeps going up from there when it comes to having multiple partners in a business. One of the key things with buy-sell agreements is you've really got to make sure that every few years you're reevaluating that. Just like what you heard in that previous thing, hey, we sat down, we realized there wasn't enough insurance and we needed to bump that up a little bit because the business was more successful at that point. So that's how a buy-sell agreement works. It's pretty simple. It requires a legal agreement, and then usually it's funded by insurance. The reason is it's less money and you get much more effect out of it. And it could be a term insurance policy. It could be a cash value policy. We use cash value policies sometimes for clients in conjunction with a term insurance policy, which is going to cover the full amount. And then the permanent insurance, the cash value insurance, could be used in the case of one of the other owners wanting to buy one out. Well, it gives them funds to be able to do that as part of that cash value. So we're going to watch one more video really quick here. And this is another situation. And it was really kind of that key person / buy-sell agreement that you're going to hear a little bit about in this.
My husband Scott liked to dream big.
He loved to golf, he loved to fish, he loved to windsurf. Anything that was outside, he was doing it.
The biggest attraction for me to Scott was that he was very adventurous, and if he had a dream, he followed it till he made it come true. He worked hard to build a successful business.
R&H was founded on radiant heating. 20 years ago, I bought into my brother's company. He had about 4 employees. We just grown from there to 60, 70 people.
Throughout the years, Scott's business increased to the point where life insurance needed to go up with it.
We worked with Steve for our life insurance, our health insurance, and our buy-sell agreement.
The buy-sell agreement allowed Scott and David to own the company outright in the event of a death or disability.
So if one of us deceased, we would have control of the company, wouldn't have to sell it or lose it.
So Scott purchased more life insurance as the business grew and as the family grew.
We got married in Boulder, and we had 2 girls. We chose to move up to Eagle, Colorado, and live on a ranch. It was our dream to raise our children in the country, and as busy as Scott's life was, he always found a spot for his kids.
On July 4th, Scott decided to paddleboard on a river to get to the picnic to meet his family and friends. The rudder of the paddleboard caught between 2 rocks, propelled him into the white water, and he was tethered and then drowned.
He would have been 52, just starting to live his life.
The worst nightmare of my life happened at that point.
It took 2 weeks for Kathy to be ready for me to come by and discuss what this looks like financially.
I found out from Steve that not only did he increase his life insurance for us personally, but he had increased it for the sale of the business to his brother David.
The buy-sell insurance allowed me to buy all Kathy's Scott shares, so now I am sole owner. So the company has no debt because we did have the insurance.
My daughters and I have to make a new life for ourselves without Scott, but he could be a part of us because we were able to stay here on this ranch. It's just a representation of who he was and how hard he worked and his dreams.
So not wanting to be sad and morbid, but once again, sharing how these type of tools can be in your business. Extremely important when it comes to being able to plan, being able to help your, your owner, or help the employees of the company, help the other owner company to be successful. Afterwards, make sure that the company is no longer in debt as a result of that. So this gives you the ability to really have a tool that is available for them to work from. So as a result of all this, that's really what we're going to cover for today. I want to make sure that if there's any questions, please feel free to put them into the chats right now. If there is anything you need, or if I can help, feel free to ask at any time. Glad to consult with anybody on this. Of course, my information, jeff@bkawealth.com is my email. My phone number is 512-785-9238, and that is my cell phone number. So you can get to me at any time. Feel free to reach out. I'd love to have a conversation with you. If you want to take a look at any of this type of stuff, I'm more than willing to sit down with you and explore what the options are, and really help you to make some decisions around that. We will be, or this has been recorded today, so I will, for those of us that, or for those people that missed the call, we'll be sharing that with everybody that signed up for the webinar. And I really want to thank everybody for being on today, and I shall release you to your to the world, and hopefully you have a wonderful day. Please feel free to really respond back to us if you have any questions or anything like that. Like I said, reach out to me. Glad to help out, and thank you very much. Our next webinar will be coming up the last Wednesday of next month. That will actually be on what's called the health wealth concept. So it's really looking at how health insurance and health planning really affect the long-term retirement planning when it comes to inside of companies, and understanding why you really need to have both of those together, because one of the largest withdrawals typically from a 401k plan is for medical expenses or health issues. So that's where a lot of hardship withdrawals come from. So we're going to talk about ways to combat that, ways to really help set your employees and yourselves up for success. So we look forward to seeing you back here. Watch for an email from us on that, and look forward to seeing you next month.